Spotify reported earnings this week and the stock jumped by 8%, taking the market cap to $48 billion. With $6 billion of cash and investments and $1.3 billion of long-term debt, the enterprise value is $43 billion. Revenue over the last 12 months is $14.3 billion, representing 13% growth year over year. Free cash flow improved to $726 million, but when you include stock-based compensation, the company is still not profitable. Net income over the last 12 months was negative $570 million, but Spotify's latest earnings report showed some strong growth. Number of paying subscribers increased 15% to 236 million, and the number of ad-supported users increased 28% to 379 million. Quarterly revenue increased 16%, but it wasn't all good news. Spotify has struggled with low gross margins for years because the company has to pay out significant royalties to music labels. Cost of revenue, which includes these royalties, increased by 14%, which helps to explain why the company posted another unprofitable quarter. High costs to music labels are unlikely to disappear. Last week, TikTok had to mute millions of videos on its platform after it failed to agree terms with Universal Music. Spotify's response is to promote independent artists and invest heavily into other audio products such as podcasts and audiobooks. A deal with Joe Rogan is reportedly worth up to $250 million. Management said that its audiobook business has quickly grown to be the second largest in the world behind Audible. Importantly, Spotify achieved strong user growth last year despite raising prices and introducing ads, and Spotify's total advertising revenue is still tiny, suggesting plenty of room for growth ahead. Let's assume Spotify can grow its paying members by 10% per year for the next 5 years and its ad-supported users by 15% per year. Let's assume it can increase monetization of its paid subscribers by around 20% and increase advertising revenue to €4 per user. In that scenario, the company could be making roughly $39 billion of revenue per year in 5 years' time. Assume a 10% net income margin and a PE multiple of 22, and the company might be worth around $86 billion in 5 years' time. That works out to an investment return of 11.7% per year. So Spotify stock isn't as cheap as it was, but the company is making all the right moves, and the significance of music labels is likely to decline over time. As a result, I rate this stock a cautious buy, but these are my personal opinions, not financial advice, and I hold no position in Spotify stock. For more investing videos, make sure to visit my website, 3minutebreakdowns.com. Thank you for watching.